We're going to dive right in. Fintech, as I said, a sound investment strategy, or would you be better putting it all on red? The huge $64,000 question. We'd just start with global perspectives and a global view, a bit of a state of play. So the current state of play for Fintech in your market or region, or regions, if we're talking globally. Do you want to start off, Victor?
Sure. Well, it's hard to encapsulate everything in just a couple of sentences, but I would say, well, the market is very hot. If you're looking at it from an investment point of view, if you are running a fintech business or already invested in a fintech business in many parts of fintech, it's a great time to sell equity in whatever form and raise as much as you can. Yeah. Many companies are what I'd say over their skis in terms of valuation, you know, being valued at 100, 200 million when they have a few million of revenue and have an awful lot to prove. And I think it was Slack's CEO a few years ago was interviewed and said, why did you raise 200 million bucks? And he said, because I could. So I don't mean to kind of just make it oversimplified, but it is a very hot space. The other thing we see internationally, but also in the US, is that it's starting to migrate more towards a corporate investing market. So in Europe, the larger rounds, so we define larger rounds, the kind of we work on 25 million and above in size, half of those rounds now involve a corporate. Yeah. 3 years ago, it was 15%. Now, corporates don't lead rounds generally, but they are very, very involved. And so that sets a stage for partnership, but also sets a stage for the migration of the market, migration of funding towards really corporate-driven investing. And there are a bunch of reasons I'm sure we can explore for it. But at the moment, the corporates, of course, don't mind, if you will, higher valuations. They look at it over a 10-year time frame, not a 3 or 4 year time frame.
Mm. Yeah, well, I do want to talk about the time frames in a minute, because we've discussed, as we discussed yesterday, some of those sort of early stage and then where do things go 10, 20, 30 years. Bringing in the corporate piece then, Ian, did you want to add anything from a KPMG perspective of perhaps some sort of big global trends that you're seeing?
Sure, and I think just to echo Victor's comments, we've seen this transition of investment from VC to corporate participation. Most of that is actually coming from Asia, which is interesting to see that the Asians are coming in pretty heavily with strategic investment. The rounds are getting larger. But at a big picture level, if we compare where we are now to where we were in 2008, so just shy of 10 years ago, there was around $100 million US invested into fintech. In the last 18 months, there's been over 27 billion, so there's been a lot. We have seen some of the frothiness come out of the market, which I think is important to put it on a more sustainable footing. And it's interesting where the capital's been going. Historically, there's been a lot of capital deployed to lending and payments, which has typically attracted around 60 to 65% of investment. A lot of that has been directed towards the Northern Hemisphere. I think the big shift we've seen, perhaps tying in more of an Asia-Pacific perspective, is the participation of the Chinese. And certainly when we look at the unicorns of a more contemporary context, they very much feature at the top of it. And what's interesting to observe now, as we look at the bats, as they start to extend, they're looking to extend by virtue of investments and acquisitions outside of their home markets, which are trends we expect to continue.
Yeah, fantastic. I mean, that global view, from your view then, Mike, I mean, what would your view be there?
I guess in the big picture, this transformation that's going on in financial services is truly global. There's certain differences from market to market and regulator to regulator or regime, but fundamentally we see everyone moving in, roughly speaking, the same direction. We also see, both from our corporate LP side and the partners that come and talk to our companies, I think globally about 32% of all venture into financial services transformation is coming from banks and insurers. So that's a big thing. We also see that we're beginning to move past the point of POC-based innovation theater into actual deployment.
Yeah, absolutely. Who are driving the choices when it comes to fintechs that we need? Do you think it's sort of business, industry, policymakers, government, customers? Andy?
Ooh, that's a tough one, isn't
Round
it?
to
Thank
you.
you very much for that. Yeah, I mean, I think a lot of it is driven by or has historically been driven by the VC community. You know, they raise the money, it's got to go somewhere, and they try and work with trends within the industry. And we had this discussion the other day about, where would you put your money now? And the thought process we're going through is, would you invest in a lending platform or a payments company? And I think my personal view would be absolutely not. It's done. So where would you go and look for? You try and see the trends that are emerging and actually go behind that. There's a funny sort of mix between that, because as Mike pointed out, Victor pointed out, you have the corporate investors coming in spades. I mean, I did a round with one of the two companies I advised this year. Our ask was 5, we raised 9.5, and it was led by a Japanese investor, a corporate investor. Yeah. So it's tough to say which is which, because the corporate investor came in, but the VCs came behind it. And I've seen the other way around as well.
I just thought it would be interesting to talk about the allocation of funds when it comes to strategy of an investment.
Sure. I think it was brought up just a minute ago about wouldn't invest in payments, wouldn't invest in lending. The issue is those were the early low-hanging fruit in this industry. And when we, as a very early stage investor, look at the context of the market, we try and look for white spaces elsewhere in financial services. So although we don't see anything in payments directly, in lending directly, we do see lots of stuff in credit scoring. We think that the capital market stack is underinvested so far. We see that a lot of insurance is still underinvested. And we begin to look for derivative opportunities from things that have already come. So I wouldn't invest in a payments company, but a company that's leveraging payments data to do fraud detection or customer acquisition,
like
or
secondary.
these kinds of things. There's a lot of that, and I think that's why we're at the beginning stages of what is a generational change in financial services, the way financial services is delivered. Fintech is just the hashtag that we use for naming what has already happened in media and has already happened in telecom, has already happened in retail. Now it's happening to financial services.
And you mentioned yesterday that we're just sort of scratching the surface there. You think there's a long way to go?
Oh yeah, I mean, there's a table that I use to show who is the top performing companies in retail, telecom, media from 10 years ago versus now. And in most of those industries, the top positions are owned by new entrants. The next positions are owned by those companies who have really embraced how things are transforming. And all of those industries are smaller than financial services, than even subsets of financial services. So I think we're at very early innings. Not that it's not self-serving for an early stage investor, but right.
Regulation playing, is that a sort of a barrier to some of that competition that may emerge, or do you see that as an opportunity as regulators look to stimulate competition in certain markets?
I think this is a really different market than many others, right? I can remember, and I'm sure you remember, there was all of these places, all over the world. Yeah, it's not because we're that old. That wanted to be the Silicon Valley of whatever, right? And now we have, 44 fintech hubs. And what's interesting is that everywhere there is a conglomeration of large financial institutions, there's an opportunity to create an innovation economy. And we see, places like Singapore and London and Hong Kong and others actually trying to lead as opposed to be a laggard, not because they want to compromise safety, but because they know they need to make some changes to provide the consumers the services that they're demanding.
Well, how do you all identify the winners? Like, how does the cream rise to the top and you
Dartboard.
pick a winner?
Dartboard in the
It's
dark.
very hard. It's very hard. It's very noisy, the market. So you would parse it at a high level between what I call single product and then broader functionality companies. So the biggest thing to watch out for is single product, single market, $300 million pre-money valuation.
Scalable. It has to be scalable.
God bless you.
Yeah.
Great. You're not a company, you're a product, right? And every one of those guys, and the other thing to watch out for is when somebody says they're a platform. Okay?
That's a buzzword, isn't it?
You're a product. Products aren't worth 400 million. And then you get into companies who actually broadened out. SoFi is a very good example, right? Starts in one part of the market, broadens out, and by the way, they're now worth serious money, and they deserve to be worth serious money. And so a company's ability to be able to broaden itself beyond a single offering. The digital banks are a very good example, right? All they're doing is selling a very simple bank account to as many millennials as they can. That doesn't prove anything. No. I mean, we could buy a bunch of millennials over a weekend. So the point is, that's fine. They're worth maybe 30 million because nice try, they have a nice stack and whatever, or maybe 50, but not 400. That's the point. So if you want to be lazy, and everybody's lazy, you would immediately parse it to single product, who's worth triple digits, and who's already multi-product. And that already will cut out 70% of the crap. Sorry.
And I think from a corporate perspective, advising a lot of FIs, I think really what delineates between those that are leading and those that are in the middle of the herd is a real real clarity around their fintech strategy and whether it's sort of fields of battle or some chosen areas they want to focus on. I think that's important because there's a lot of noise, and most big FIs are getting 3 or 4 fintech companies knocking on the door every day. So it's really important those FIs have identified those 5 or 6 areas that's where they want to play, and then that's where they're going to win. And it's a question of how a fintech company can be a part of accelerating or strengthening a winning position in those areas. I think that's really important to get that clarity. And we launched a report today which showed that of the 168 FIs we've surveyed globally, that only 46% of them actually have a fintech strategy in place, and less than half of them they would suggest are aligned to the corporate strategy. So there's a lot of work to be done in the context of FIs getting very clear around where they want to play and how they're going to win.
Yeah, and is it also, I mean, we discussed it yesterday, but is it also the person that's sort of at the helm? Like, is that person important? And we were talking about, you know, do you go sort of for a tech Silicon Valley person coming out, or would you prefer someone who has that real financial services knowledge and is sort of in the background?
In the corporate or in the startup? Right?
In the startup, let's just go there.
I mean, in the startup, I'm biased, right? Because I do think most startups are going to need relationships with the existing industry to create an exit for me. So I'm biased towards a team that has a balance of came from the industry and came from you know, Stanford's engineering school or something like that.
Yeah, yeah. I would totally agree with that. I mean, you see with one of the startups, she's working with blockchain for the quick, well, I forget what they call it, the rapid traders, where the settlement has to be almost a minute. She came out of JP Morgan's, was one of the leading lights in default swaps. So, you know, there you have the classic. She's moved from being innovative in the financial service institution into being, you know, the CEO of an early stage startup.
That said, regardless of whether you're in a corporate or in a startup, you need someone leading who is going to defy gravity, who's going to like get up every morning and run through a brick wall, because one way or another you're trying to change the world.
Yeah.
And it's going to be hard.
And there's that entrepreneurial street person.
So your question's a very hard question. So, I mean, we see these companies.
I love
where
the hard question.
200 people or something, right? So their culture is built, et cetera. So, and the question is, if they were started by, and the DNA was financial services, what do they look like? And if they were started, the DNA was tech, what do they look like? So, and you really see the differences. I mean, like, so let's start with a couple of negatives. Is if they run for financial services, typically they're built to Deutsche Bank standards, right? When the company's tiny. I mean, just the amount of money they put behind, you know, redundancy of systems, et cetera, is out of all order to what the volume is that they have. They need to be ready for any eventuality, which is also great. Run by tech people, and it's exactly the reverse. I mean, one of the reasons why these companies that I mentioned before won't survive a DDoS attack is, again, because they are run by people who are kind of put it together, ramp quickly. Net, I would probably err towards financial services, net, just because it's a trust business at the end of the day. And it's hard to hire great people in certain functional areas if you're really a tech company, meaning compliance in, you know, these kinds of areas. It's hard. The culture needs to be able to embrace that. And the culture needs to embrace slowing down when you need to get things right. And if it's really driven by kind of a B2C tech culture, to be extreme for a moment from the beginning, it's hard to get that, and typically those sort of people are harder to fit into an organization.
The funny thing is, like our companies, and again, we're very early stage, they are having a remarkably easy time finding really good financial services people who are bored out of their minds in what they're currently doing.
Because they feel restrained and everything they're seeing and reading, they want to be involved.
They want some excitement. They want, right? So,
well, we've just seen.
But we'll see again.
Yeah.
None of mine, you know, with few exceptions, are big enough to know whether that works.
You see too much tissue rejection downstream.
Yeah.
That's the problem.
Oh, fair enough.
When somebody says, "Look, we need to spend $6 million in order to fix this," and you know the tech team at the top says, "You've got to be kidding me! That's $6 million we could have spent on customer acquisition."
Have you ever seen any massive culture clashes?
Oh God! Oh yeah.
Oh, there's going to be a few.
Okay, shoot.
There's going to be a few.
Give us some, 'cause I think it's interesting.
Just think about this. There's a neobank, German, that was bought by a French major bank. The culture clash between the CEO of that German bank, which did a fantastic job, don't get me wrong, he's brilliant, but he's one of those guys who just runs through brick walls. Now, how that sort of culture is going to fit with a large French bank is going to be very interesting to see how that pans out. You know, It's different, but it needs managing. And what you don't want to have happen is that the large institutions suppress what made them buy that company in the first place. That you've got to actually be able to adapt, but that means it's all across the board. And give you an idea, I went through 2 money center acquisitions actually in-house, and the cultures, when you even between banks and they're doing the same thing, the 2 different cultures coming in, it's like you wouldn't believe it. But that's doing the same thing, bringing in an early stage consumer bank on one side and putting it in with a traditional consumer bank on the other. That's major in terms of sandpaper and potential.
Where you see the culture clash, I'll give you an example. You have a CEO who is a technology person, but is mature, grown up, et cetera, driving the business, really focused on marketing. You have a COO, comes from financial services, right? Everything's fine until you hit a rock in the road, okay?
Yeah.
And then what happens, right? What often happens is the COO wants to be CEO, and as soon as you hit a rock, says, well, we wouldn't have hit that rock, ... And then you have the split in the company that happens, and if you don't manage it properly, you have 2 camps quite quickly. And when you had people collaborating before, I've seen it in a month or 2 because of some major issue, and they literally have 2 different worldviews about the same problem.
Yeah.
Plus, you of course get the ambition and jealousy factors, which hit every company. To bring it back up, the melding of those 2 cultures when you're ramping a business at some scale is probably one of the most underrated risk factors in fintech companies across all functional areas. And it's something that a lot of investors don't really pay attention to, because when they invest, they normally come from the tech industry, investing in fintech. They don't really think about it. Well, hire a compliance person. Need one, go get one.
This is exactly how we determine who we want as follow-on investors in our company. If they get that, right? If they've been investing in fintech, they get that.
Yeah, but
I was going to suggest, I think FIs are alert to that risk of cuddling the baby too much too early, and everyone's getting a chance to hold it. It's kind of sort of not going to end in the right sort of place. And I think we're starting to see those leading banks who recognise if they're going to acquire a business or bring on board an entrepreneur, which is another dynamic we're observing, that FIs recognise there's a market opportunity. That market opportunity can be best realised not by deploying someone that's been in the organisation for 30 years, but actually bringing in an entrepreneur with the right skill sets, but giving them the right level of empowerment, investment for them to create a new business, but doing that outside of the organisation with the right support, of the management team. And I think that's an important element of it. I think FIs are attuned to some of the challenges that perhaps have held them back historically.
Yeah, I'm conscious of time. These things always just sort of fly by. I just want to touch very quickly on RegTech, because we talked about it yesterday. I think it's a huge space, and I guess that may be a little bit to sort of where we're going next. But your view on that as an area?
It's a big problem to solve. I mean, if we look at today, banks and insurers, asset managers are collectively spending $90 billion a year on risk and compliance. That's predicted to rise to $120 billion over the next 5 years. So I think the key thing is that this is a permanent fixture. This is not we had the GFC, we responded, and now we're coming back to some sort of new normal, which looks like significantly less costly than what it was after the GFC. The reality is that cost is going to remain significant. And the reality is a lot of FIs, and they may be different in different markets, have thrown bodies at the solution to get over some of the imminent questions they needed to resolve, whether it's cultural or harder in terms of regulatory compliance. So that is a massive issue for the industry. It's not going away. So you recognise there's a lot of RegTech players that can actually look at that. And if we look at the investment in RegTech, it's growing quickly. Already, so the sort of first 6 months of this financial year has exceeded the level of investment last year. So it's around $590 million in US dollar terms, and last year it was sort of 550. So we're well on target to break a record as it relates to RegTech.